To keep you updated on the capital and financial markets, here is a recap of what happened.
In response to the growing presence of financial influencers and the widespread use of technology, a new guideline governing advertisements for capital market products and related services took effect on the 1st of November. First issued by the Securities Commission Malaysia in 2020, the revised guideline is meant to level the playing field, ensuring that finfluencers who share investment advice are held to the same standards as those licensed under securities laws. The Malaysian capital market has expanded dramatically in scale and complexity in the more than 3 decades since Securities Commission Malaysia was established. Today, the capital market is worth more than 4 trillion ringgit. But the regulator's fee structure has remained stuck in the 1990s. That is expected to change come the 1st of January when the SC revises its fee structure for the first time ever, raising fees and introducing a new one based on the value of assets managed, which will go some ways towards shoring up the regulator's own finances. The Finance Ministry has given its in-principle approval on the revision, and the new fee structure is currently under review by the Attorney General's Chamber. The mutual fund industry of Bangladesh remains tiny and underdeveloped. Mutual fund assets amount to barely 3.5% of total equity market capitalization, one of the lowest ratios in Asia. The limited size of the industry is not due to a lack of savings or interest. It reflects a deep trust deficit rooted in the structure and governance of the funds. For many years, Bangladesh relied on closed-end mutual funds. These funds issue a fixed number of units for a fixed period, usually 10 years. Investors can sell their units only in the secondary market, not back to the fund. When asked whether investors should have more access to private markets, especially as public markets may no longer serve the interests of long-term investors, Ravi Menon says the industry must re-evaluate whether each of the regulations that are in place for public markets are worth their cost. He stressed that private markets are not for the faint-hearted and that better collective investment schemes will be needed for retail investors to participate. He also noted the irony of retail investors investing in single securities in the equities or fixed income markets with no restrictions given that those are highly risky. Ultimately, diversification remains key. Should there be products coming out of the private equity and the private credit market that are collective in nature and have a balanced risk-return structure, then private and retail investors are able to take part in those opportunities. Just a couple years ago, China was uninvestable to some global money managers as its economy reeled from strict COVID-19 curbs and a crackdown on private enterprise. Now, central banks, sovereign wealth funds and insurers around the world are bidding for the nation's international debt like never before. The mood change was evident by how easy it was for China to raise a combined $8.6 billion by tapping both the dollar and euro bond markets in the last 2 weeks. Bids for the two bonds reached a record total of at least $234 billion. Investors' robust appetite allowed China to borrow dollars at essentially the same cost as the US, followed by unprecedented demand for its offering in the single currency. Read the latest issue of the e-Zine available at FIMM's official website to stay updated about what's going on in the industry. FIMM is pleased to announce the release of its latest annual report, now available on its official website. Link in the description.
This has been the FIMM TV Weekly Recap. Be informed, stay updated. Be sure to like, share and subscribe.